Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to talk about the latest oil and gas and mineral rights news for March of 2026. And Justin, the theme of this year seems to be geopolitics. And, particular, this first article seems to really be focused on the conflict with Iran. And as a result, no surprise, oil prices have skyrocketed since that conflict or disagreement has sort of come to a head with negotiations over Iran's nuclear program.
You said it, man. At the end of last year, we were talking about how we were worried about the prices of oil coming into 2026 and throughout the year. And as so it does, anything can change it. First article here is oil prices hit 7-month highs as tension rise before U.S.-Iran talks. And as you mentioned, Matt, U.S. crudes rose from $67.28 a barrel on Monday, while Brent crude touched its highest level since the 31st of July at $72.50 a barrel. And then prices fell back, but we're up again on the Tuesday morning. This is kind of what we expect to see when there's this geopolitical tension going on, especially when you're talking about a country like Iran, who is so oil heavy. And the Strait of Hormuz is a big problem if there becomes conflict in that area.
Yeah, I think you hit the nail on the head there. And the analysts that are looking at this, there's one quote here said that oil markets were, quote, rationally trying to price in a risk premium for oil prices given the disruption a conflict could have on global supplies. So I think what you end up having here is just the mere hint of a potential conflict has caused the market to respond, and oil prices are reflecting that risk premium. And if something does happen, I wouldn't expect prices to go much higher necessarily. I think it's already priced in at the current level, given the supply and demand that we've talked about and how there was a lot of downward pressure overall from a macroeconomic standpoint. And, with demand being lower than supply largely, and you have these geopolitical issues, first with Venezuela, now with Iran and things like that have caused oil to sort of rise again above where we were expecting it to be. I think at the beginning of the year, we've touched, below $60 a barrel from West Texas Intermediate standpoint. So I think from a royalty owner standpoint, the good thing is that these sort of issues that have been going on have sort of bolstered prices, higher than I think the market would have otherwise priced oil at. So it remains to be seen, I think, whether how long that lasts, I guess. If, hopefully things will be handled diplomatically. There won't be any sort of military conflict. And assuming that's the case, I think we'll expect to see prices fall a little bit, back down closer to $60 a barrel. But, for now, at least for the month of February, we've had sort of a little bit of up and down. Interesting notes here that the overall market has sort of responded to this already. And I think a lot of times when you have a conflict breakout, people are like, oh, I need to focus on that. I think price of oil is going to go up higher, and, we react surprised when it doesn't. I think that, again, we have, downward pressure from a supply and demand standpoint, but then you have the geopolitical stuff going on that is sort of keeping it elevated. And as we're recording this right now, price of oil is around $66 and call it, give or take a little bit higher than that. So above where it started the month. And I think, again, we're looking at, depending on what happens in Iran this week, as we're recording this, it's February 26th. And I think we'll know a lot in the next week or so as to what to expect there. And if the Strait of Hormuz, like you said, there would be a disruption because of military conflict, or if, the Iranian crude will continue to be sold on the market, in which case I think we'll see prices come back down a little bit.
It'll be interesting to see kind of what pans out. And, like you said, Matt, maybe some of the pricing is baked in, but we see this higher price sustain longer. If the conflict happens, do you expect that we're going to see the price go up some? I know we were in an oversupply situation throughout the end of last year. So my thinking is that we've got some ways to go to kind of meet that gap that we already knew existed.
Yeah, I think you're right. The next one here is interesting. It's kind of along the lines of sort of longer term energy, I would call it transition, and things like that. And this is really focused on coal and natural gas power plants. And the title of this article is U.S. Coal and Natural Gas Plant Closures Delayed. And it goes on to say that the U.S. energy transition is slowing with planned coal and gas plant retirements delayed due to Trump-era fossil fuel policies, raising electricity demand, and growing fears of blackouts. I don't know that I agree with that statement. I do think that it certainly, those retirements are due to the current administration's policies related to energy. Electricity demand is definitely happening due to AI data centers and also some of the industrial reshoring. There apparently is some level of manufacturing coming back to the U.S. that's being a small part of that demand equation, I would say. Another aspect is electrification, right? So as we've been over this past, say, decade, a big push towards electric cars, towards heat pumps and all of those things, that puts additional demand on the grid, and that, puts upward pressure on electricity prices. And we're all seeing that, I think, at the end of the day. And then the other side of things is, as there was a big focus on wind and solar and things like that, in Colorado here, where Justin and I are, Xcel Energy is the largest energy supplier from a grid standpoint. And they've been really focusing on phasing out natural gas and coal and focusing on putting in more wind and solar capacity, which is great when the wind is blowing and the sun is shining. But the real issue becomes when, there's a cloudy day or it's, calm, that we don't get the supply of that electricity that we need. And so they have to maintain some level of backup, just in case the wind isn't blowing or the sun isn't shining. And so that is increasing the energy prices, right? Because they have to build both the solar farm as well as a backup, natural gas power plant that can be there when the demand is there. Otherwise, you have rolling blackouts. And we have seen that in Colorado. And obviously some of that is due to weather and things like that. When it's really windy and whatever, can cause issues, with power lines and things like that. And sometimes they actually will proactively shut down certain areas if the wind is going to be really bad, just because they don't want it to spark a fire. So we've seen some of that here in Colorado. And I think, you extend that out to the rest of the country, that, extending these U.S. coal plants, and, it's not that big of a surprise to me, honestly. One of the data points here, Justin, is that it says that the EIA says that 11 gigawatts of power generating capacity was expected to be shut, with nearly 60% of that coal-fired and the rest natural gas. And they said that only 4.6 was retired in 2025, which is about half of what that prediction was, again, following orders from the Department of Energy to extend the operations of those plants to meet demand. What were your thoughts on how this, is playing out as far as the refocus on, the more reliable and maybe arguably dirtier coal plants, and then, lesser extent, gas-fired power plants?
I really think it creates an interesting problem in the United States. Our infrastructure is aging, and I think, the talk has been about a lot of electrical hikes as far as the price goes to consumers. And that's a must to be able to kind of overhaul this infrastructure we have that's aging. And this article projects a 20% increase in consumption by 2030 compared to 2025. And Matt, that's technology, all kinds of different factors that go into that. But it's going to be interesting to see how they handle that. We were talking before we hit record. I attended NAPE, and a lot of the talk was behind the meter power generation. And I think that comes from a couple different aspects for industry. One is that, they have control over this, and they're not relying on infrastructure that's aging, maybe companies that aren't able to repair this as promptly as they need, and they want to be able to control that. And those contracts are being signed directly with operators, like we've talked about before. So it'll be interesting to see, is industry going to kind of curb this by taking control into their own hands? How might that impact royalty owners? And then are we going to see a lot of infrastructure overhaul when it comes to electrical? Because if we aren't able to generate more power by 2030, we're going to be looking at a major power shortage. In January, the Department of Energy released a report saying that if nothing changes in the existing plan to supply electricity to the grid, the risk of power outages will be 100 times higher by 2030. So, Matt, that tells me that we're growing at a rate that we need to be aware of, and it's going to take investment to be able to handle that.
Yeah, you're exactly right. And I think that this is an interesting issue that we have with AI and the amount of electricity that's required for these data centers. To your point, that the grid can't support that. And so they're going to the source where there's the cheapest electricity. And that's, a lot of these natural gas fields. And particular Permian Basin is, I think, perfect for this, not from a climate standpoint, just because it's so hot and it's hard. These things need to be cooled, but that's something they can overcome, but it just means it's a little bit more expensive to operate there. But, we see these deals like we talked about in episode 306, where we talked about AI data centers and natural gas prices and kind of the outlook there. But, I think that you get this behind the meter thing makes a lot of sense for these operators because they're, particularly in the Waha hub in West Texas, gas prices have traded at a negative price. In other words, they're paying to get rid of the gas because there's just so much of it there locally and they don't have enough infrastructure to sell it to the market and take it away. So putting in these data centers and, the behind the meter power plants makes a lot of sense for the operators because they can make some money on selling the gas, and then the companies that need that reliable and affordable electricity can create a footprint there and get a long-term contract in place. Sort of a win-win right now. It's good to see that being really a focus, because then the other thing that does is it doesn't put the pressure on the grid, and it doesn't increase the price to the consumer. Because if you have these AI data centers going in, say, a metropolitan area where you're competing against domestic uses for like heating and cooling and things like that, all that means is that there's increased demand and there's a fixed supply based on the amount of that the grid can support. And that just means that prices are going to go, even higher than they have gone over the past several years because of this increase in demand. So I think seeing this, focus on extending the life of these coal-fired power plants and natural gas power plants makes a lot of sense, from that standpoint, just from a reliability in the grid, meeting demand. I do think there needs to be a focus on, minimizing the environmental footprint of coal and things like that. And, there's some mention in this article about extending or pushing back, the time when they have to deal with some of the waste products of the, the coal ash and things like that, and, storing it in unlined pits and letting companies do that. And I think, we got to make sure that we're still providing a focus on, having sensible, but also enforced, environmental policies to make sure we're not causing any sort of pollution issues. But, to the extent that we are doing that, we're not building any new power plants, which I think was an interesting point in this article, Justin, is when you compare us to China's building, I forget the number, it's almost like a new power plant per day, a new coal-fired power plant per day in China. And they're using, electric, wind and solar and every sort of form of electricity possible. But in the U.S., we're not building new coal-fired power plants. So I think that's something to take away here as well, which was interesting.
You said it, Matt. And the thing that I can't believe that we're not talking about nuclear. And I guess it was a few years ago now, there was some movement in technology when it came to small reactors. And that was something that looked really promising, but it'll be interesting to see as we try to meet this demand by 2030, if we're going to see those small reactors become part of the infrastructure or something that we're relying on. Obviously, that would be a very dependable way to do this.
Yeah, absolutely. And, with Chris Wright as Secretary of Energy, I know he's always had a focus on those small modular reactors and expanding the nuclear capacity. I think they just got to revamp that whole permitting process and the approval process within the Department of Energy. And that's going to take some time, but hopefully they do continue to focus on that and they are going to be able to deliver something that will allow those types of projects to move forward. Because I know he's mentioned that, but we haven't seen anything yet. So I guess maybe it's going to take some time, but I hope that ends up coming to fruition.
It would be a great thing to see, that's for sure. All right, Matt, our last story here is a pretty fun one and a pretty interesting one. So a Texas family gives away oil and gas rights in a viral $1 million sweepstakes. The sweepstakes is called Win My Mineral Rights, advertises what it describes as a rare opportunity to acquire mineral rights in Frio County, Texas, a region long associated with oil and gas production. The offering is being promoted through raffle, an online sweepstakes platform, rather than through a traditional sell to an energy company or investment firm. The article goes on, the mineral rights have been held by the same family for over more than a century and are currently leased with a 22.5% royalty. The acreage sits over Pearsall Shell Formation in South Texas and is described as being adjacent to active drilling by the same oil company